Hello and welcome to a new episode of Under 360 English. Today we are going to discuss about 5 important things that you can learn from the past stock market crashes. So we shall have a quick look on were the past historical crashes happened. In 1929, the Great Depression, usually we call it as 1930. Anyway, 2930, that time was the Great Depression. Second thing is 1946, post-World War II. 1961, Cold War concerns between USSR and the US. 1968, high inflation and the Vietnam War. 1973, the end of Bretton Woods monetary system. 1980, interest rate hikes and raising the unemployment. 1987, due to the introduction of computerized trading. 2000, the burst of dot-com bubble. 2008, the collapse of US housing market that caused an economic recession around the world, Lehman Brothers and subprime crisis, etc., etc. And 2020, the infamous COVID, lockdown and the market crash. So what all things you can learn from these crashes? That's what today we are going to discuss. Stay tuned, keep watching. What are the learnings from all these market crashes? First lesson is never be panic in the market crashes, provided your holdings are fundamentally very strong. Don't exit means there is no restriction on exiting or selling that and book losses for the purpose of loss harvesting to save some taxes. Nothing wrong in that. But try to re-enter it at a better price or that time itself. Make sure that the panic that should not grip you or your sales decision should not be decided by the panic situation that triggered to you. Lesson 2, your SIP investments, systematic investment, monthly investment or something like that. After analyzing the fundamentals of the company in which you are going to invest, you are investing in, you do a rigorous fundamental analysis, because during the market crash and everything, most probably some of the sectors may go dull. For example, even in the last COVID crash itself, that time some sectors like leisure sector, hotel sector, that were on the back foot for quite a long time. Now only they are raising up. So if you feel that sectors may have a long-term impact, you pause further investment in that sector. Instead of that, you switch the companies which are less affected due to that. Third lesson is never invest in lump sum. Along with that, you make sure that whatever may be your SIP investment that ongoing, let it happen. Because majority of the people, they have a feeling that when markets start to crash, they have a feeling that will go till index reaches zero. The same mindset is there when stock price goes up also. People will think this is an endless journey to infinity, and within a couple of months itself, this index may double. Both these feelings you should take out. Think wisely, think intelligently. Follow a system in investment as well as trading. So if you are having an ongoing SIP on a fundamental stock, let it go. Never try to stop it, so that your previous investment on that particular stock may get averaged. The fourth lesson is never try to average the stocks which are in loss, or never try to sell the stocks which are in profit. So if you are an investor, if you have invested in some stocks which are 2 to 3 years back, most probably you would have been there in the profits. But when the market crashes, still that may be in the profit. Maybe before the market crash, you may be sitting on 300% of returns, but now it may be 150%. Still you are in profit. So people have a tendency to exit from that stock with a feeling that anyway I am in profit. But on the other hand, what they will do, they will exit from that stock and take that money and try to average the stocks which are already in loss. But during the good times of the market itself, some stocks may fail to come up, and you are trying to invest more money in that also. So while in a crash or when in the testing time, if some stocks are still not showing any strength, make sure that you exit from that stock and try to invest in some quality stocks at a cheaper rate. That's an opportunity to get into some quality stocks at a cheaper rate. For example, during the market crash, Reliance has reached to almost 1,000 rupees. Now it is 2,600 rupees. Almost 260% returns you could have get in 2 years. On the same time, many low quality stocks, they went down drastically during that market crash, but they couldn't come out from that depression. So this is the power of quality, fundamentally strong stocks. So during the market crash, if you have funds with you, make sure that you consider that as an opportunity to invest in some quality stocks for a long-term investment. The last point is, historically, it is proven that none of the market crash has been sustained forever. Market returned, recoiled, bounced back with double the force. That's the nature of market. That's the nature of human mankind. So learn from history, believe in history, trust on the patterns provided by the history, and every crash and every fall should consider as an opportunity to enter the market at a cheaper valuation. So thanks for watching. See you in the next episode. Till then, bye from Manu.